Why do some candles form at the exact moment the market is about to reverse? And how do certain candle shapes signal that buyers or sellers are losing strength? Today, we're breaking down the patterns that reveal the market's next move. Welcome back to the channel, and if you're new here, you're watching SMC Precision Traders, where we simplify trading and make price action easy to understand. If Forex, synthetics, and smart trading education is your thing, then make sure you hit the subscribe button and turn on notifications so you don't miss any part of our series. Thank you. Alright, let's get into the video, the candlestick patterns that reveal market psychology with surprising accuracy. Every candlestick pattern is a message, and once you know how to interpret these messages, the charts stop looking random and start making sense. Now let's get into these candlestick patterns. The bullish engulfing pattern. A bullish engulfing pattern forms when a small bearish candle is swallowed completely by a larger bullish one. Visually, it's simple. Red candle first. Bigger green candle next. And the green body covers the entire previous candle. This pattern often appears at the end of a downtrend. It signals that buyers didn't just show up, they overpowered sellers in one candle. It's a potential reversal. But before taking entries, always wait for the next candle to close higher for confirmation. Next, let's look at the bearish engulfing pattern. The bearish engulfing is the opposite of the bullish engulfing pattern. And to identify this, you'll see a small green candle, followed by a larger red candle that wraps around it. This usually forms at the top of an uptrend, a warning sign that sellers have stepped in aggressively. As you can see from the chart, when this price action pattern occurs in an uptrend, we can anticipate a trend reversal because buyers are no longer in control of the market and sellers are trying to push the market to go down. Strong pattern, but again, wait for confirmation before acting. Next is the hammer. The hammer is one of the simplest but most powerful signals. It's a candle with a small body, long lower wick, a little to no upper wick. This shows that price dropped, but buyers forced it right back up. It's a sign of rejection, and you'll often find it around support zones or the bottom of a downtrend. Next is the shooting star. The shooting star mirrors the hammer, but it's flipped. It has a small body, long upper wick. It appears at the top of an uptrend. It signals that buyers tried to push price higher, but sellers pushed it back down, giving a clean warning of potential downward pressure. Lastly, let's look at the doji. A doji forms when price opens and closes almost at the same level. It represents indecision, a balance between buyers and sellers. On its own, it's neutral. But after a strong trend, a doji often hints at momentum slowing down, and sometimes a reversal is upcoming. These patterns are essential building blocks of price action. The more you understand them, the more clearly you'll read the markets with ease. In subsequent videos, we'll show you how to combine candlestick patterns with market structure for deeper accuracy and smarter entries. If this video was helpful, don't forget to like this video, subscribe to the channel, also turn on the notification so you don't miss out when a new video is released. Also drop a comment if this video was helpful. Feel free to drop any topic you would want us to make a video on and we will look into it. This is SMC Precision Traders, trading with clarity and precision.